Hey everyone, I want to talk today about the fractal nature of charting. What does this mean? Well, this means that the same principles apply on charts of different time frames because we're looking at, when we look at a chart, we're looking at basically human psychology, right? And there are traders that have different time frames, but the same psychological things come into play, whether you're a day trader, or a swing trader, or a long-term trader. And when we look at charts, we can see some of these emotions manifesting themselves. Now, let me explain what I mean here. Here we have the CME group. This is the 1 year chart. And we can see here, notice how this level was support and it became resistance. Now, how could a level that was support turn into resistance? Well, it happens because there are people who bought here and who, when the price went lower, a lot of them become remorseful and they regret buying and they tell themselves, hey, I want to sell, but I don't want to lose any money. So I am going to try to get out. I'm going to try to get out at break even. So if the market gets back up to where I bought, I'm going to sell. So support can turn into resistance because of buyer's remorse. We can see here that we have support stays intact for a while. Support stays intact for a while. Now notice how when we get to a support level, sometimes we get these rapid little bounces. Now, why does this happen? Well, it's because the investors who create the support with their buy orders start to sense that there are other buyers around. That's why the stock isn't going lower anymore. So they get afraid they're going to miss their shares, miss buying because someone might be willing to pay a higher price. And if there's someone who's willing to pay a higher price, the seller is not going to go to you. It's going to go to the person who wants to pay the higher price. So the buyers get antsy and they start to outbid each other. They start to pay higher prices and it causes a snowball effect and that causes the bounce. So we can see that down here, here, here. This whole thing about market memory you might have heard of, right? That's when these levels can retain their importance for a while, support and resistance. When a market's going lower, it's because there's not enough supply or not enough demand to absorb all the sell orders. There's not enough buy orders to fill all of the sell orders, so the sellers have to sell at a discount, and this forces a downtrend. Resistance, oh wait, sorry, this forces a downtrend. When we get to a support level, this is where the buyers come out of the woodwork, and the sellers could sell all they want, and the investors who are buyers sense there are other buyers around, so they start to outbid each other, and that forces the uptrend. Resistance is the opposite. Resistance is a level where there's enough supply to fill all the demand. When a market's moving higher, there's not enough supply. The buyers can't buy all the shares that they need, so they're forced to be willing to pay a premium, and this forces the shares into an uptrend because they all start getting ahead of each other. Now you have to understand if you listen to the media or a lot of these pundits, you got to take them. A lot of them really don't know what they're talking about, right? They try to make every single little move on the stock is because of they try to make it seem as though every single move on a stock is because of some kind of fundamental reason that's going on. They'll be like, oh, market's up because of this, market's down because of that. The vast majority of the time, all that's really moving the market is psychology and perception. I mean, look at these some of these bank stocks that collapsed yesterday down 60, 70%. Today they're up 50%. What happened in between? Well, it's just psychology, right? Um, why did this move happen here? Well, as a trader, I would say, well, we got a big move lower because we broke support. Breaking, I mean, because we broke support. Now, if you put on the media, they would probably say, oh, CME group's down because of this, or CME group happened because of this. And most of the time they're wrong. So I tell my students, just don't even bother listening to the news. When a support level breaks, it means that the price trades below the support level. This tells us something. Remember, we want to look at every chart through the prism of what does it tell us about supply and demand. Well, if we're trading below the support level, it tells us that the investors who created the support with their buy orders aren't in the market anymore. They've either finished their orders or they've canceled their orders. Regardless, they're out of the way. Anytime you take a lot of demand out of a market, well, the supply side or the sellers are going to have to pay lower price or sell at lower prices, and that's going to force a downtrend. I don't pay attention to too many patterns, but I do think the ascending and descending triangle patterns are worth paying attention to. This here is your classic descending triangle pattern. So we have the support level down here. Now let's think about what this tells us. There are buyers who are down here who are kind of just hanging tight, right? They're content with waiting for the sellers to come to them. Here we have this series of lower highs. Markets don't go in straight lines. They go in peaks and valleys. And when the peaks are forming at a lower level than the prior peak, it shows us that as time is passing, the sellers are getting more aggressive. They're more willing to accept lower prices. So when you have a market where you have complacent buyers and aggressive sellers, it sets the stage for a move lower. All right, so now let's look at a different time frame. Here is a CME chart of 5 years. And we can see here that some of these same principles are coming into play. Here we have support becomes resistance. This is our buyer's remorse. They're investors who bought here who regret doing so. Now, these are longer term investors, but they are still investors or traders. People who bought here regret doing so when the price went lower, and they tell themselves, I'm going to buy my shares back if I can get them at the actually, sorry, I got that wrong. So this is buyer's remorse. There's people who bought here and they start losing money and becoming remorseful. And if we have enough of these remorseful buyers placing sell orders at the level that was support, it can turn into resistance. All right, here we have resistance stays intact for a while. Resistance can turn into support. This is seller's remorse now. People sell, the market goes lower. When it goes higher, they tell themselves, I regret selling. I want to buy my shares back, but only if I can get them at the same price. So if you have enough remorseful sellers placing buy orders at the level that was resistance, the level turns into support, like here. So here we have resistance becoming support and support becoming resistance. So seller's remorse turns resistance into support. Buyer's remorse turns support into resistance. You can see down here, sometimes these support and resistance levels can stay intact for a long time. This resistance level was from mid-2019 until mid-2021. So this is a 2-year resistance level, and this is what we call market memory. All right. Now let's go look at the one-day chart, the chart from yesterday. Once again, we see some of the same principles. We see resistance. I'm going to go with a pen here. We see resistance converts into support. Support converts into resistance. So we have, this is the world of day traders now because we're looking at just one day. So we have people who sold. When the price goes higher, they regret doing so. They tell themselves they're going to buy their shares back, but only if they can get them for the same price they sold them at. And if we have enough remorseful sellers placing buy orders at the level that was resistance, it can convert into support, like here. Here we have support converting into resistance. If we have enough remorseful buyers placing sell orders at the level that was support, support turns into resistance. We can see here that this resistance level stayed intact for a while, and once we got there, we got these kind of rapid sell-offs. Remember, these are sellers undercutting each other because they're afraid they're not going to be able to get their shares off. When we get to support, we can get these rapid moves higher. This is buyers overpaying each other or trying to bid higher prices, which causes a snowball effect, right? So we tend to come fast off of resistance levels and we tend to rally off of support levels. We can see down here another example of resistance becoming support. So it's the same principles regardless of the time frames. And that's because when we look at a chart, we're looking at a graphical illustration of human emotions. And there are people who trade a 5-year time frame. There are people who trade a 1-year time frame. There are people who trade a 1-day time frame. Regardless of what you look at, you're going to see the same principles playing out. And it's a lot easier to understand if you look at this through the prism of what does it tell us about psychology and supply and demand. All right. Thank you, everybody. Hopefully that's helpful, and I will talk to you soon.